Hi everyone. This presentation covers selected topics in professional ethics. Nearly every decision that a CPA must make involves some ethical dimension. Ethics are involved whenever the welfare of one or more other individuals is affected by the results of the decision. An auditor's ethical dilemma may impact thousands, if not more people. The CPA is indeed a representative of the public with regards to the financial reporting process, and they have a responsibility to the public. A CPA must be credible. If the public loses confidence in CPAs, then their attest function serves no meaning. No assurance will be provided. A credibility crisis hurts both the profession and the economy. The profession, through the AICPA, sets standards which help protect the profession and the public. Indeed, violators face disciplinary action. The self-governance of CPAs, historically through the AICPA, was questioned as a result of accounting scandals in the early 2000s. As a result, the Sarbanes-Oxley Act created and empowered the PCAOB to develop and enforce ethical rules for audits of publicly traded companies. The PCAOB has adopted much of the AICPA code as their interim standards. Figure 3.1 is an image that explains the overall AICPA Code of Professional Conduct. The pyramid of that is that the AICPA establishes overall principles or a framework to help guide CPAs. Key terms within the principles section include integrity, objectivity, independence, and due care. A member must consider each principle in determining whether or not to provide services in an individual circumstance. For example, a number of years ago, I worked for a small local CPA firm who in the past had not done audit engagements. This particular CPA did have audit experience working elsewhere, but in their own firm, they had never done audits. And they were thinking of starting to do audits. And he had created a proposal. And indeed, the client had accepted the proposal. In the end, however, that CPA, in using the principles as a guiding light, had decided not to take the engagement. It would have been lucrative, but in using due care, the CPA decided that they did not have the necessary education or the resources to do an effective job. Another example might be if a client comes to you and asks you to do a valuation of their business, where you set the fair market value of that business in light of the possibility of selling the business. That's a specialty area. If you don't have experience in that area, you would be better off not accepting that engagement. Another example involves non-attest services, such as preparing tax returns. If a CPA has a client who divorces, you would not continue to do the tax returns for both of those clients. So, in part, a CPA must learn how to say no. Section 2 of the AICPA Code of Professional Ethics covers specific rules. So figure 3.2 lists the rules. Rule 101 and 102 have been adopted by the PCAOB as interim standards. But you see, overall in figure 3.2, independence is at the top of the list, but we cover many things. Confidential client information, can you charge contingent fees? What are acts that are considered discreditable to the profession? Okay. Even the form of organization and standards regarding names that you can adopt for your firm. Let's look closely at independence. Figure 3.4 is a flowchart to help you decide whether or not there is a threat to independence. So, an issue arises. The first thing you have to ask yourself is, does the Code of Professional Conduct directly address that threat? So again, going back to the code, we have specific rules governing independence. So if it's an actual violation of Rule 101, then that's a simple decision. We can't do that. Our independence would be impaired. So if it is an actual rule, a specific thing that's violated, such as I may not have a direct financial interest in a test client, then I would have to follow the rule. So I would not be allowed to participate in that engagement. But what about those gray areas that are not actually covered specifically within the code? Is it open season? Can we do as we please? Well, the answer is no. We are then to look at it from the viewpoint of a third party. So the question is it reasonable to expect that the threat would compromise my professional judgment? Well, you're not making the decision based on whether you feel it would. You really have to make this decision based on the perspective of a reasonable and informed third party who has knowledge of all the relevant information. So you need to step out of yourself and say, somebody looking at the situation from the outside, if they would conclude that there was impaired independence, okay, then I have a problem. So, is it reasonable to expect that the threat would compromise my professional judgment? Again, would a reasonably informed third party with knowledge conclude that it would compromise professional judgment? If the answer to that is yes, then I must ask whether or not we have safeguards in place that would eliminate or reduce the threat sufficiently. So the types of safeguards really fall under three broad categories. There can be those that are A, created by the profession or legislation, regulation, such as perhaps educational requirements, licensing standards, so on and so forth. So that's one category. That would be safeguards that are imposed from the outside. The second category would be safeguards that may be implemented by the actual client. So perhaps through the experience of their management or the effectiveness of their board of directors, the potential threat to independence could be mitigated. And then the third one would be those safeguards that may be implemented by the CPA firm. So strong policies and procedures, perhaps leadership, training that emphasizes independence. If you can honestly say that the safeguards are in place such that a reasonably informed third party would have confidence that there is not an impairment of independence, then you would be able to conclude that independence is not impaired. Okay. Going back to the top, if a reasonably informed third party would look at the potential threat and they would be able to conclude that your independence was not impaired, then independence is not considered to be impaired. Similarly, if we have safeguards in place, okay, and a reasonably informed third party would be able to conclude that the safeguards are not sufficient to mitigate the threat, then independence is impaired. So I hope this presentation helps you understand a bit more about the ethical dilemmas faced by a CPA.